Fantastic to have you back, and thank you for joining us. When we started the year, everyone had this lofty number for the Sensex and the Nifty. The general view was that the party would roll over from 2017 to 2018, which it did. Which it did.
Yes, yes.
And then we reached a climax.
That's true.
So the market behavior was telling me earlier that everyone was bullish, and now it's how to find the bulls again.
No, I'm sure. I think look at the framing. I think you use the word party, and a lot of investors use the word that when markets are on a rise, they use it's a party which is going to continue for a long period of time. But I think if you are participating in that kind of a party where you you are like a Cinderella, right? But you're looking at a clock which has no arms, so you don't know when it's 12 a.m. and everything turns to pumpkins, right? So when making money gets very easy, I think it's time to run out for serious investors. When I say run out, you don't really sell everything. It's time to be very, very cautious. I recently came across this very nice, interesting question from, I heard it from someone when he asked that why do people like getting scared on a roller coaster but don't like getting scared in the stock market? And stock markets are like roller coaster, right? If you don't like getting scared in the stock markets, I think if you are fearful of short-term volatility and stock price jumping up and down, then I think you don't belong in this game. Making money in stock markets is a slow man's game. I wrote an article yesterday where there are 4 ways of getting rich. The first is you own a bank, and we are seeing what is happening with banks these days. The second is you inherit wealth from someone else, which is also not in your control. The third is you marry someone who's rich. Again, a lot of us would have blown up this chance. And the fourth and a much more controllable way of getting rich is to spend much less than you earn and invest the surplus and let it compound over a longer period of time. You only need to get rich once, so I think there's no hurry to do that. People who get shaken up by volatility, I think should be very careful whether they should be in the stock markets or not.
This theory of sit tight, buy right and sit tight, yes, believe in the power of compounding may not work for each and every stock.
Yeah, that's right.
How does one differentiate? I can give you a list of stocks which are down 99%. Some of them don't even exist. They existed 10 years ago. A stock like Unitech, stock like Arcom, look at where they are. So for someone who thought, look, I'm going to be buying these businesses because Unitech had a lot of land bank and Arcom had a promise of Anil Ambani group backing, they've not made money by this buy and hold strategy.
That's right. So when I say buy and hold, it does not really mean buy and forget. That's the first thing. The second thing is what you are buying, the kind of businesses that you're buying also makes a lot of sense. If I look at the Indian markets, and if I go back, and I did a research sometime back when I looked at the 5 good businesses at the peak of January 2008. And if I were holding on to those 2 businesses, or if I had bought them at that prices till last year, that is 10 years later, I would have made a minimum of 20% CAGR on those kind of stocks. On the other hand, if I had bought the dud businesses, the businesses like you talked about in terms of Unitech and construction companies, after they had fallen 95, 99% by March 2009, and I had bought them thinking that how much more could they fall, I think over the next 10 years, you've lost another 90-95%. So I think it entirely depends on what kind of businesses you're buying. And then even when you buy good quality businesses, you buy, review, and then decide whether you want to hold or not for a long period of time. Time, I think, is very important. Time solves a lot of problems in life, and time also solves a lot of problem when it comes to investing. You need to give your investments a lot of time. Yeah.
Right. Vishal, so you're saying deploy these dips and corrections that the market is giving us, use this as an opportunity and start buying.
I'm not really saying that. What I'm saying that if the best way, one of the best ways of dealing with volatility is that first you completely avoid that, right? You stop getting worried about volatility. But even when you look at stock prices jumping up and down, and when you look at stock prices of for example, prices of stocks that you have been eyeing in terms of businesses, you need to treat such kind of volatility as opportunities in disguise, right? So it's like Ben Graham's Mr. Market parable that this guy is manic, this guy is depressive, but you don't need to really take advice from Mr. Market. You don't need to really take advice from stock prices. You need to take them as opportunities and then decide whether you want to buy at a given price for a given stock. But the point is that I think if you do your process right, if you find good quality businesses, I think it's a matter of time. You need to hold it for a long period of time. You think like a business owner, as simple as that. People focus on returns, but I think that is the only thing which is not in our control as investors. If you look at, there are multiple other things which are in our control. You can control the time that you invest in the market. You can control the cost that you pay when you are investing in the market. You can control your behavior to some extent. And the only thing that you don't control is return. But ironically, people focus only on return and not on the other factors that you can control. So I think that's sad.
So you're saying that irrespective of volatility, all the bad news, just buy right, buy the stocks that you fundamentally believe in and sit on them right through this volatility. Eventually, you're going to see the fruits actually ripen. Great point. But, tactically, Vishal, one always... in times like this, when just about anyone that you're hearing out from the market is saying that 2017 was a great year, but do not expect 2018 to be like that. 2019, India's got a big election coming up, so don't expect 2019 till the election result comes out, us to have a great patch, so to speak. 2017 was the best that you've had, and leave that behind you. You try and always juggle your portfolio, right? You always think whether you're safer within the large caps. Within the large caps, should you be in IT, pharma? Should your portfolio have a defensive texture, or should you stay with the mid and small caps? Would you think that that would be a prudent strategy to try and juggle between large caps and small caps and mid caps as a strategic, strategy for your portfolio?
No, I think my advice would be to be market cap agnostic. I think you should, rather than worrying about whether it's a large cap or a mid cap or a small cap, I think you, as I mentioned, you need to look at the underlying businesses. There are a lot of wealth creators from the small cap space. There are a lot of wealth destroyers from the large cap space, and vice versa. Right? So I think my point is that you need to be market cap agnostic. You need to look at good quality businesses, and then you decide whether you want to really hold them for the long term. I think these, as I mentioned, these kind of volatility or volatile times provides you a good entry point sometimes. And mostly, if you are already owning a portfolio of good quality stocks, you just avoid such kind of volatility. So I think that's the point that I would stick to. Yeah.
Vishal, it's very easy for us to identify good businesses. Good businesses are the ones which have a moat around them. They are great capital allocators. They grow without raising capital, and they have a decent amount of cash flow. That's the characteristic of a good business. And typically, a good businesses which fall under these 4 or 5 headlines or these tick points are FMCG companies, consumer companies, to some extent 1 or 2 manufacturing companies.
That's right.
The challenge with an HUL, a Dabur, a Nestle or a Britannia is that P multiples are scary. 40 times, 50 times. Titan is trading at 70 times 1 year forward.
That's right.
So there are good businesses out there, but some of valuations are so way off the mark that you don't know what to do. So what does one do? What you want to buy is not cheap.
No, I'm sure. I think, and good you, for example, could you name a stock like Britannia, for example? I was just reading a news a couple of days back when a stock like Britannia has done 10x in the last 5 years. Yeah. So just because these are so obvious names in front of you, in front of us, we ignore such kind of businesses and we stop looking at such kind of businesses because we're all focusing on those fast rising, fast moving small and micro cap stocks. I think the point is that it's very important to keep looking at businesses, as I mentioned, with irrespective of whether they're well known, whether they're small caps or large caps, and you buy them when you find opportunities. I remember Buffett saying that investing is simple but not easy. He says it's simple because the rules are all in front of us. As you mentioned, it has to be a good business, you need to buy them right and sit tight, right? So everyone knows about them for the last 50, 60 years. But the point is that it's very difficult to behave in that way. It's very difficult to actually practice what you already know of, and that's a difficult part. So for long-term investors, markets provide opportunities from time to time, even in well-known obvious names. You've seen like stocks like Asian Paints, Titan crack by 30, 40, 50%, but nobody's looking at them because everyone wants a second rung or third rung small cap, mid cap stock to make money fast.
So for someone who says, look, I don't want to look at my stock portfolio on a daily basis. I'm happy to look at my stock portfolio on a monthly basis. I'm a genuine investor. A 15% volatility, a 15% sell-off is not going to scare me. What could be a combination of 3, 4 or 5 stocks one should buy for someone who says, look, I have patience to buy and buy these stocks for next 5 years?
Rather than going stock specific,
give me the businesses.
Yeah, so in terms of, I talked about themes as well. So I was just talking to someone, and I just 2.5 years back, I actually drew a living room And for my daughter, when she was 11, I was trying to explain how to look at stocks and businesses. So I drew a living room, I drew a bathroom and a kitchen of a typical house, and we identified there were like 50 or 60 businesses that we interact with on a daily basis, and they are good quality businesses, right? And I asked her to pick up around 10 businesses that she knew about, right? So 10 well-known brands that she knew about, things like Voltas, things like Asian Paints, Pidilite, Nestle, Bata, all these brands which even a child in India, 11-year-old child in India would know of. And she picked up those 10 businesses, not in real life, but on paper. And when I tracked, and I just forgot about it, when I tracked the return from those stocks, those 10 stocks, which are obvious businesses and easy to understand businesses, just a few months back, over a 2.5-year period, those stocks as a portfolio gave me a 65% return compared to a BSE mid-cap, which gave me lesser return, or a BSE Sensex, which gave me just a 30-35% return. So I'm not saying that it's very easy to throw darts and make money in the stock markets, and my daughter needs to understand that she would be arrogant to just look at 2.5 years and say that I made good amount of money. I don't need to learn about this stuff.
I think the problem is that